Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm here with a video about the 6 scenarios that I believe are the most likely scenarios you run into when you are investing in stocks on the stock market. And yeah, investing is not difficult. If you just look at it from this way, you open a brokerage account, you put money onto your brokerage account, you pick a stock, you give in an order to buy that stock, the brokerage firm executes the order, and you own the stock. In that regard, it isn't hard at all. But in fact, it isn't that easy either. First off, you have to be able to save enough money in order to have savings left that you can spare, that you don't really need, that you then are able to put towards investing into stocks or ETFs. But in order to do that, you have to analyze your companies, because when you don't analyze your companies before you invest your money into it, then you are in fact just gambling. And gambling is the shortest way to lose money, and that's not what you want to do on the stock market. You want to gain money. But when you have invested onto the stock market, you know that you are going to deal a lot with psychology of human nature, because people get scared. Some people get scared more easily than others. And when there is negative news or positive news, your stocks are going to go up and down like crazy, especially in these times. I say these times they are really volatile. So you have to be able to deal with that. And then you have to realize that there are two kinds of people on the stock market with the same goal, and that is making money. But the one person is there for the long run, and that's an investor, and another person is there for the short term, and that's a trader. And for me, the next scenarios, it's going to be depicted really basic. I know that, but just bear with me. And I think the next 6 scenarios are the scenarios that you're always going to run into when you're investing into stocks. And when you know where you are, you know how much, how careful you should be when you want to invest towards stocks on in that scenario. So a scenario is always going to look like this. You have the owners of a stock in a certain company A, and there you have investors that are sellers, and you have traders that are sellers. I believe the majority of owners of a stock are investors. Sometimes maybe that's not true, but it's just a schedule, so just bear with me. And on the other hand, you have people that don't own the stock yet, or maybe they are already owners of the stock and they want to buy more, and that is investors that want to buy the stock, or you have traders that want to buy the stock. But on the other hand, you also have traders that want to sell the stock, and for that they lend the stock from certain brokerages or other parties on the stock market. And you also have sellers that already own the stock, but they believe that the stock is going to go down, so they start selling their stock and with the aim of buying it back later. Just like short sellers are actually short selling the stock by lending them out and then trying to buy them more cheaply thereafter. But in the bigger scheme, everybody is trying to make money on the stock market. So you have 4 parties. You have the investors, you have the buyers and the sellers. They are here. And you have the traders, the buyers and the sellers. So the sellers are represented in both parties. And then you have the first scenario, where you have a status quo. And there you can actually see that the buyers and the sellers are more or less in equilibrium. So everything is fine. Investors do their thing and traders as well. And in this scenario, it is okay for investors to invest. Stocks will go up and down according to how the companies are actually performing. So you still have to be aware of the fact that you need to do your due diligence, because you can still win or lose money in this scenario. Because it's never guaranteed that you are going to win money or win or gain money. So you always need to do your due diligence. And then you have the second scenario, and there positive news comes into the world. And in this scenario, the investors, they keep selling and buying as normal. So nothing changed for the investors. But the valuation shoots up as traders come in and they start buying as well. Maybe new investors come as well. So you have a few more investors that come as well. That can happen as well. So this is a situation that most investors want, because in that scenario, the price of your stock is going to go up. And then you have the more expanded scenario of scenario 2, and I call it scenario 2 bis. And then you have a positive spiral. So imagine you have another positive news coming into the world, and traders really start buying as they believe that the momentum is in their favor. So more traders come in and they start trading more and more and more. They want to buy more and more stock, and the price is going up. So it's a spiral that goes reinforces itself. And with this scenario, the investors, they will start selling more. And investors should, in that scenario, always be careful for starting to buy and moving along with the traders, because it is tempting to follow the traders on that moment. And yeah, momentum traders, it is called momentum traders, it's not called momentum investors. And you always have to keep that in the back of your head, that you don't get carried away with the sentiment of traders on that moment. Because for the long time, in the long term, valuation valuation models are saying on that time to not buy it. The PE valuations are way too high. But yeah, the stock keeps going up just because more and more traders are coming in. On that moment, should investors sell for the long term? That's another question. Sometimes they can do that. They can take their profit and then wait until the positive spiral is over and the stock drops again to get back in. And like that, they secure their profits. And that is what traders do every day. So day traders, they come in the morning, they trade the stock up, and then before the the day is over, they have already took their profits. So should investors do the same? That's a question that only the investors know on that time for themselves. But they shouldn't complain when the stock goes up even 50% more after the time that they sold. So you always have to be careful about that. This situation always cools down, but it can go on for a long time. And certainly when there are few sellers, I believe that Bitcoin is in this thing. You have a positive spiral already from the get-go that it was created. There was a buzz about Bitcoin because it was a detached coin, and more people are starting to buy it. They say they are investors, but in my eyes, they are always traders. It already exists for 12, 13 years, Bitcoin. And in this way, yeah, it can go on for another 10 years until the 21 million of Bitcoin are available and all on the market. But one day Bitcoin will go down. And then you can say there was a bubble. And in another regard, the positive spiral can also be related to a short squeeze. So you all remember the short squeeze of AMC and stuff. So the people got hyped by finfluencers and started buying. They were trading buyers on that time. They believed they were investors, but in fact they were just trader buyers. And they offset all the trader sellers. So you had trader sellers, that was true. So the finfluencers weren't lying. When enough people came in, they were offsetting the trader sellers, and by doing so, the price of the stock shot up. And it went to the moon, as they said. But eventually, the buyers dry up because on a certain time, the valuation of a stock really becomes absurd, and then even the most influenceable people aren't putting their money towards buying the stock, and then it's going to start tumbling down. So in this case, you have here the graph of AMC. So here the finfluencer started talking about the stock and saying, hey, there are a lot of shorters on this stock, and when we put enough money towards it and just have diamond hands hold the stock, not making them available to stock lenders, people, the traders, or the short sellers need to start buying back stocks on the market, but there aren't going to be any, so the price is going to shoot through the roof, and that was what happened. So the price shot up, and after that it went down. Then yeah, as always, you have a bit of a yo-yo, so it goes up and down, up and down, up and down. But the long-term movement is that it cools down. You saw the same with the dot-com bubble. So here you have Cisco Systems. It went up to more than $75 in the beginning of 2000. And the people that bought on that point, they are already waiting for over 24 years to get their money back. And Cisco is a good firm. So it's not like AMC. AMC is going to survive probably as well, but it's not going to be in the same order as Cisco. Cisco is still a good firm. They are making a lot of money. They are still growing. And now they are profiting from the AI bubble a bit as well. But Cisco, yeah, eventually the people that invested here and they are capable of waiting another 10 years, they are certainly going to see their money back. But as you can see, it goes up very fast and then it goes down very fast as well, just like AMC. Then you have scenario 3, where you have negative news. So now not positive news, but negative news. There, the traders start selling. The investors, buyers, and the investor sellers, they do more or less the same. Maybe you have a little few less sellers because, yeah, when the stock is moving down, people are not that keen on selling their stock. Some people need to sell their stock because they need the money, but normally when you are a long-term investor and your stock is going down, you believe that the stock isn't overvalued anymore. So maybe it's undervalued and maybe you should buy more, but you can't really say it. So that's scenario 3. The stock is going to move down a little bit just because the sellers are trading the stock a little bit down. When there are enough buyers to buy on the negative news, not much is going to happen. But then you have the extension on that scenario, so 3 bis, and there you have another negative news coming in. and another negative news coming in. And there the trader sellers come in more and more and more. Here you also have the sellers that increase a bit, and the buyers, they decrease a little bit, and the investor sellers, yeah, they remain plus minus the same. So they keep doing their thing as they believe that the momentum is in their favor, the trader sellers, and the investors start doubting. And with that, you have fewer buyers compared to the amount of sellers. So the price is going to drop faster than in the scenario 3. In this scenario, you can start to question if you are an investor, should I buy, yes or no, because the stock is going to get undervalued in many valuation models. But there, the due diligence that you need to do is really crucial, because look at this, you have Nestlé, you know I bought it, but it's already from 2022 till now, so already 3 years in a row that the stock is trading down, and it keeps continuing. Nestle is a really good firm. For me, I believe it's a really good firm, but it is more or less in a negative spiral, but not completely in my eyes. For me, the turnaround is just around the corner, so that's why I got in around here this price. And then you have the Swatch group. You know I'm a firm believer of Swatch as well, but yeah, 2021 till the end of 2022, it traded down. Then there was the Moon Swatch. It was really positively, how do you say it? It was positively received by people. So investors got on Swatch again, but after the numbers, they said, yeah, it's not going to last the success of the Moon Swatch. In fact, it did. It's still really popular. The new one that came out was also sold out in no time. So it still performs good, but yeah, the problems with China have the upper hand, because they sell a lot of stuff in China, but now with the lesser cells in China, the stock is trading down. And I believe investors are exaggerating. So I got in, I believe it was around here. So then it dropped, then it came up again. I was slightly positive, and now I'm negative again. I'm only negative with seven francs or something like that. But yeah, it's the way it is. I believe the next year it's going to be a difficult year for Swatch, so 2025. But from then on, it's going to only go upwards for Swatch, because they have nice products, they have a nice production team. But that's just what I think. What you think is more important for what you are going to do with your money. So it's not financial advice, it's just observations that I make when I look at the stock markets. But I hope that Nestle and Swatch don't come into scenario 3 tris, so the sixth scenario, and that is the negative spiral. And that's the opposite from the positive spiral, scenario 2 bis, where you have a lot of trader sellers, and even the investor sellers start coming, because yeah, it's really a negative spiral where the stock is getting into. So the sellers are winning the race compared to the buyers, and the price starts dropping fast. For me, as you look at the price drop of Nestle and Swatch, it's still going slightly down. So it people may think it's really fast, but for me that's not fast. It's still pretty slow, and the traders take over. So investor buyers, they are almost non-existent, because yeah, you really have to take a risk when you are investing into such a stock because it's in a negative spiral, and they start to panic, the investors. So for me, I think for investors, when you see a negative spiral, you have to stay away from those stocks because it's a very dangerous period. You can lose a lot of money when traders are really starting to trade a stock down. It can go really, really, really fast. So the two worst sayings on the stock market when we are faced with this scenario are: do not catch a falling knife. You all heard that phrase before. So in this regard, when a stock is in a negative spiral, this is a falling knife. So I always suggest wait until it hit the floor, maybe bounce back already one time, and then when you are certain that it's going to go back up, then maybe you can start investing. But when it's falling down, really don't touch it. And the other saying is buy low, sell high. And I think that is one of the most dangerous sayings on the stock market, because when a stock is going down like crazy, every day is the lowest point that it has reached in quite a long time. So now it's more than 7 or 8 years ago that Nestlé was on a level around 73 Swiss francs. So is that low? Can it even go lower? We don't know. So selling high, that's easy. When it reaches an all-time high and you sell, you are always selling on a high. And when it goes higher, you can say, yeah, I didn't know it, and I still sold at a really high point, and you took a profit. But selling, yeah, is actually locking in a win. But when you buy low and it goes even lower, then you are taking a loss. So you can gain a lot of money in this scenario when you buy at the right time, but you can also lose a lot of money and really fast. And in this regard, I can show you Meyer Burger. So the solar panel company, it keeps having troubles, and it's moving up slightly a bit again the last few days. But if you look at this, this is a fast drop. When you see this happening, run as fast as you can. Take your losses and don't look back. That's the biggest advice that I can give. So the conclusion for investors, not for traders, because traders, they just go for the short term and they can make a lot of profit in any of the previous scenarios. Investors, not. So in the long term, and I speak then for 10, 30 years, that's the long term for me. Scenario one is what you have on average on the stock market. But you have the saying from Benjamin Graham: in the short run, the stock market is a voting machine, yet in the long run, it is a weighing machine. So in the long run, it is a weighing machine and you have scenario one. But in the short term, you often have scenarios two and three. And whether or not you should sell in scenario two, that's up to you. And whether you should buy in scenario three, that's also up to you. But the things that I can say is when you see scenario 2 bis, then you have to stay on the sideline. Don't jump in and get carried away and run along with the traders, because you can buy on a really high point, just like when you should have when you could have bought Cisco at above $75. That can happen when you get carried away with the hype that is going on in scenario 2 bis. And if you want to sell on the moment that it's running up, yeah, when should you sell? That's a difficult question. And when it starts tumbling down again, when will you buy back? So that are two really difficult questions to ask and to answer, but you should always think about them happening, and you have to make up your mind and decide for yourself. And if you see three bis or three dis tris happening, always be very careful of what you are going to do. Do your due diligence so that you lose as little as possible. I often trade in three bis scenario, so with Nestlé and Swatch. I never trade in three tris. I try to stay away from that scenario. When I see a stock tumbling down as fast as Meyer Burger, I stay away from it as far as I can be. But I take a gamble when I see 3 bis. Whether or not you should do that as well, that's up to you. You know yourself your best. And yeah, if you buy, like me, Nestle or Swatch, just be careful that when it switches over to the scenario 3 tris, that you sell as quickly as possible so that your loss is as low as possible. And with that being said, thank you for watching to this one and see you on the next one on my YouTube channel. Bye.